Hey, asset revestors, it's Christopher Mullen from thetechnicaltraders.com with our quarterly revesting report. And I want to recap on the markets, where we think we're at, what's unfolding, the big picture views of these trends at play. But just to quickly recap on what revesting is, asset revesting, it is where we take control of our capital and more or less we only invest in assets that are going up in value. As things start to top and lose momentum, we will move away from that asset and look for a different asset that is rising in value while the rest of the markets are falling. And by understanding how the markets move, you can see here, we can identify when the market is in a bullish stage or a bearish stage, when we want to be owning stocks, when we want to be out of stocks or profiting from falling pricing, or potentially owning a different asset class altogether that is going up in value while stocks or bonds are potentially falling. So that is what we're going to cover. Just to recap quickly on how the markets are broken down, because this is very important to understand the market stages. Stage analysis is important because your strategies need to adjust and change, and so does your mindset and expectations of the markets. More or less, the market has 4 stages, and a stage 1 I have shaded here as a red market condition. It's a dangerous, difficult, trendless, choppy market. Stage 2 is a bullish phase. These are very strong, powerful trends that can last many years. A stage 3 is a topping phase. This is what I believe the markets are in right now. We're in this complacency move to the upside, going back up to retest near these highs. And then we have a stage 4 decline, which is a big financial reset. And that is shaded green as well because it is a big trend to the downside. And as a trader, an active investor, doesn't matter if the big trend is up or the big trend is down, we can profit from those strong trends. So that is what we need to understand. And a stage 4 decline is a big reset in stocks, generally commodities, currencies, real estate. It is usually a big, broad swath of chaos for those who don't understand what's unfolding and how to take advantage or at least just avoid it all along. And, if we were to kind of look down here to another chart, I don't really need to go across the emotional side probably again, but right now I believe we're in this peak maximum financial risk. It doesn't matter if you start a new business, you buy a new home, you invest in stocks. This is up in the nosebleed section. We are up in this stage 3 topping phase. A lot of investors and advisors think this move that we've had this year, which has been strong, but really it is just a complacency, a retracement rally, trying to get back up to the previous highs. And what happens is when the market starts to roll over, all the investors who have redeployed money or reset their mindset expecting us another 5 to 10 year bull market start to get anxiety as we start to break down. And they can't believe that that could be going into another bear market. They just survived the 2022 bear market. How can this happen? And then eventually, as price keeps collapsing, they just go into denial. They cannot believe how much money they've lost, how many years of work has just vanished of their life savings. Eventually, they panic. They bail out of the market. They become angry and depressed. I have been through this cycle or seen this cycle many times. And it is very important and critical to make sure you avoid this type of scenario. Now, as an asset revestor, instead of this negative downward move and this emotional and financial pain, we actually relive this optimism, belief, thrill, euphoric phase. For example, right now, or we're in a kind of a complacency mode where we're kind of optimistic that the market is going to break down. And when people are more so have anxiety, we definitely have optimistic. We're like, okay, price is breaking down to a stage 4. This could be really, really good for us. This will reset asset pricing, allow us to profit from the reset. As people have denial, we'll be in full unbelief going, yeah, this is a bear market. This is a good thing. We can benefit from it. And then as people have panic, we're actually having a thrill going, oh my gosh, this is like taking candy from a baby. And then eventually as people bail out and take massive losses, we're just like, this is icing on the cake. We're loving life. Well, everything is getting revalued. We're growing our accounts so that we can invest in some new long-term assets when the market puts in a bottom and starts to reverse. So that is the really critical thing to understand. Doing anything now investment-wise carries a, to me, maximum peak risk. And we just have to see how this market overall is going to move going forward. Now, if we take a quick look at the cycles of the markets, we got the blue stock market cycle. We have the yellow economic cycle. The stock market cycle will top before the economy. Businesses slow down, earnings targets get missed, earnings start to get lowered, investors start to move away from the market. They can see things are slowing, that a recession is coming. Several quarters later, the market has bad financial numbers, and then finally the economy goes into a so-called recession. At that point, the stock market is already well underway, and a huge chunk of damage is already done to investors who are not savvy and don't follow the price of the stock market, but they follow news and the Fed and their gut feeling and things like that, which are generally off the mark from how things need to be managed in terms of a trader or investor standpoint. The other thing is, these are the last two commodities here, these two kind of pockets that do very well before the stock market goes into a stage 4 decline. Oil has been on fire. Energy stocks have been the leading sector for several months this year. And gold is up, trading near all-time highs. It's just been trading sideways for a couple of years, holding its value. And so the fact that all of these things are coming together is a warning sign that this market is potentially getting very close to a big reset and recession, and it could last a long time. This actually, the setup we are seeing is more so like, to me, the tech bubble burst of the 2000s, and it could take a long, long time. It actually took 12 years for the SP 500 to recover, 16 years for the NASDAQ. This isn't something you want to mess around with, especially if you are a little older and close or already retired. That is a long time to be losing money and not generating any returns. So let's go and take a look at the markets where we are right now. If we I just mentioned this is the tech bubble burst. This is the SP 500. You can see it took a long time for these markets to break out. We'll cover this with the NASDAQ because it was a little more so of the NASDAQ kind of tech bubble. But what I want to show here is we are in this complacency rally. If we just zoom in on this chart, we had the bear market last year in 2022. This year, the market put in a little bottom. Now we're having a pop, and now it's kind of pulling back a bit. This is a complacency, what so far looks like a complacency rally. And we had one back over here. Whoops. If we go take a look at the 2008 market top, we had a breakdown in price. And then we had a complacency rally here. It was a little shorter in terms of how long it lasted, but then the market broke down. People got anxiety, they had denial, they panicked, and got out of the market. Down where big volume is where everybody panics, and these huge spikes down, and then the market started a fresh new rally. Now these are big pullbacks. When we look at these pullbacks from the highs, we're looking at a 57% pullback. That is a pretty hefty loss to take. So overall, I do feel like this market is going to sell off and have a very big correction. But let's take a look over at the NASDAQ out of curiosity. If we look at the NASDAQ chart, again, this is the monthly chart, so we get to see the big picture views. Now let's go over here. If we take a look here, you can see the NASDAQ pulled back 47%, and then it had a super strong rally of 63% after that. And this here was the complacency rally. If we jump to where we are, let me actually just zoom out a little bit here. Whoops. This market, as you can see, we got to go way forward. It did not break out till way over here, 2017. 16 years or so later. So this is a pretty major potential reset. And if we go over to where we are right now and take a look at the price, We have seen last year, we saw a 37% pullback. We saw a 52% rally. This is very, very similar to the big tech bubble burst and financial reset. And when we go into a reset, that is going to pull pretty much all asset classes down, or at least precious metals, stocks. There will be things that go the opposite direction. For example, if we take a look at the US dollar, and let's zoom back here to the 2000, and during the 2000 breakdown, we saw the US dollar skyrocket higher. During the 2008 bear market, we saw the US dollar skyrocket higher. Both of those are probably what you signal. We're probably going to see something like that again. I think we're going to see the dollar skyrocket back up near the 20 or the 2000 tech bubble levels. And as the dollar rips higher as a safety play, a safe haven play, that will put pressure on precious metals. And if we take a look over at gold, we can see here the 2000. This is what I'm really excited about, is we are getting into a major super cycle to the upside for precious metals. This was the 2008 financial crisis. Gold pulled back 34%, but I feel as though we are starting a new major super cycle in gold. And that means when we do have selling in the stock market, this is likely to pull back again. But overall, this is a bullish pattern. And then we're going to go a lot higher going forward. But this is going to be a huge opportunity. And just think, if you look here, this huge rally in the dollar that lasted many, many years, in gold, was in good part because we saw the US dollar sell off for all of those years. And when the dollar gets back up to these levels, I do believe we're going to see eventually a reevaluation. Dollar will go down for many years, and that will send commodities skyrocketing higher again. It's just major cycles that continue to kind of play out in the markets. So knowing these, let's look at the stock market. This is the weekly chart of the SP 500 with our overall kind of long-term investors kind of trend analysis. Now, as you probably have heard me talk about this before, I like to look at the stock market like the ocean. The tide is either going up, and a rising tide lifts pretty much all boats. This is when we have strong trends, strong asset revesting signals. And then we also have the tide going down, which is when the market is out of favor, or the equities market at least is out of favor, and trades become shorter lived, a bit different strategies applied, things need to be adjusted. Right now we are back into a upward bias trend. But again, this overall, I still feel as though is a complacency type of rally. The market still may rally up and put in a double top, maybe even poke to nominal new highs. And depending what the market does once, or if it gets back up to these highs or pierces those highs, is going to be, I think, interesting to see how those unfold. I think we could see the markets poke to nominal new highs. That will get a lot of people on side, start to buy. If big institutions start selling into it and we see it get hammered very quickly, that will be a huge red flag that this will end up being a more or less major double top, and we could be going down for a huge, huge decline of 40, 50 plus %, and could take a long time, many, many years to recover. But again, we're not going to get ahead of ourselves. It really doesn't matter which way the market goes, because we're technical traders. Once a new trend is established, we hop on it, we ride that trend. When it loses its speed, we move out and move to a different asset, so we can profit from rising and falling prices. And we don't have to try to guess or time the markets. We literally let the markets turn our direction, create a new trend and confirm it, and then we move in to follow that trend. So that's kind of how we're looking at the markets right now from a big picture analysis of where we're going. Let's actually go take a quick look over at crude oil. Again, these are all monthly charts. If we go and take a look at crude oil, what's pretty interesting here is back in 2007, 2008, we saw crude oil consolidate here for a little while and then have this huge blow off move into 2008. And then we saw it sell off and it found some support in this area with a 1 month bounce. And then it went into a stage 4 decline with the rest of the financial markets. And this is, if we go and take a look at what's going on here, we've had that consolidation in crude. We had a big blow off move in price. Now it is coming right back down into the support area, and it is holding up still very well. It's had a very strong rally, starting to reverse a little bit right now. But overall, if the market starts to break down, we go into a recession, stage 4 decline, we're probably going to see crude oil collapse and tumble. But we have seen very similar type of scenario as we saw back over here during the last financial reset, where crude oil had the blow off phase, came back down, and then eventually broke with the economy, with the stock market as well. So let's go take a look over at gold. Actually, we'll take a look at gold here, the monthly chart. As I was mentioning before, gold is trading in this consolidation. It's holding up the best among all precious metals, simply because it's a slow, low volatility asset. Means if something's slower and more stable, more people are comfortable with it. They put more money into it, and it becomes a much more stable asset simply because of that mindset. It's kind of a self-fulfilling prophecy. And so people have been moving in and holding their value in gold. But when we go to different metals like silver, it's a speculative metal. It is down quite substantially from the all-time highs. If we go back, it's down about 56%. Again, gold is equivalent to trading up here. So you can see how speculative, fast-moving assets just aren't finding big money to be parked there yet. They're still nervous. They're not willing to put their money in. Silver can lose 30% in value very quickly, 10, 20% very quickly. So that is one of the reasons why it's kind of underperforming. That's the same with gold miners. If we look at gold miners, they have been moving down. They're well off their highs from 2011 market top. If we go look at some other metals real quick here, we can look at platinum. Platinum is down fairly substantially, although platinum looks to be trying to build a base and trying to stabilize. If we look at palladium, we can see how it formed a head and shoulders formation, a neckline. It's breaking down and fizzling back down towards potentially a support level down over here. But what's a good way to look at all these is through the ETF GLTR. And this ETF here holds gold, silver, platinum, and palladium. And while it doesn't go back really far, it still actually gets the 2012 highs. What I like about this is it gives you a view of what all the metals are doing as a combined group. And if you know chart patterns, this chart pattern here is a giant cup and handle pattern. And this can be one of the strongest, especially when it is a 10-year plus pattern. Huge potential. The way you can measure this is roughly from the top of the cup to the bottom of the cup. And then you can literally, just stack this on top 2 to 3 times, sometimes in some cases 4 to 5 times upside potential of the depth of the cup. So if we are going into a new 2000 style financial reset where commodities eventually will start a 10-year rally, this could be very, very exciting. This ETF is a good way to get a hold of different metals, because you don't really ever know exactly which metal is going to skyrocket. So it gives you a nice, comfortable taste of each of those metals. It is heavy weighted in gold and silver, much smaller portions in platinum and palladium. But it's an interesting pattern to see this all unfolding, and it could be a good way to take advantage of the precious metals space. Now, if we go and take a look at the 10-year note real quick, let's take a look at the 10-year note. I've talked about this several times. Very strong chart pattern. It has broken out. A few months ago, I was talking about how we're looking at 5.75% to the upside. A lot of people were like, there's no way it's going up there, but that's what the charts have been showing. And if we look at the big picture here, the 40-year cycle, I mean, we have been in a falling interest rate environment. It has now changed direction. We could just draw a quick line across here. You can see how we've kind of changed direction from downward, all of this consolidation, these highs, and we busted through that. We built a tight little bull flag above it and settled down into support. and now it's starting to rocket higher and still has potential here to move up, I think, quite a bit more going forward. So that is going to put pressure on bonds. This chart here is pretty much the inverse of the bond market. If I was to just pull this up and say we just take a look at here, we've got rising interest rates. If I go to the TLT ETF, which is the bond ETF, it is the opposite. We're breaking down new multi-year lows, and this is doing a ton of damage. In fact, with our asset revesting strategy, we got out of bonds at the high for TLT for a 19% rally during the COVID crash. So pretty powerful. And to see where it is, bondholders are down roughly 50% on their bond positions, which is generally 40 to 60% of their portfolio. So this is a huge hit towards investors who are very passive, who have, money just parked with the buy and hold strategy. I mean, as soon as interest rates are going to start going up, I mean, they've been at zero. They couldn't really go a whole lot lower. So as they start going up, you should have been out of bonds. They are one of the worst asset classes to be in, and holding them just goes to show lack of really protecting your capital and understanding of how the markets move. There will be a time when bonds become another very powerful play to the upside. But that time just isn't yet. And it'll take a lot of work for the market to put in a bottom, form a bottom, and then start a new uptrend at this point. But be very cautious. The bond market is still in a collapsing phase and could unwind. We could still see interest rates continue to go higher and higher, depending on how inflation and unemployment numbers are. So the Fed still has full control and has completely damaged investors' accounts with the rates going up and killing bond investors. Anyways, that's really about it at this point. We are looking at the markets. We are waiting in a cash position. If we actually take a look similar to a cash position, we are in a position BIL, waiting for a new opportunity. So the way this works is more or less it pays out a daily dividend, or the daily dividend is included in the share price. So it goes up, and then eventually upon end of month, all of this amount gets paid out in a dividend, and then it resets. So if you buy in near the beginning of the month and you ride it up, you can exit and you would have collected that dividend. If you hold it through the whole period, the price will reset, but you get paid out that monthly dividend. So this is a nice way to just consistently keep growing our accounts while we're sitting on the sidelines, something that goes up pretty much every day in value and pulls our account up while we wait for the markets to generate a new signal, whether it's in currency like the dollar or bonds or stock market again. Anyways, that's it for this quarterly report. If you like what we're doing, you like this type of analysis, feel free to go to thetechnicaltraders.com. You can go to our strategy. We have our CGS strategy, which if we take a look here, you can see it's this long, thick blue line. You can see how it compares to the blue underneath, which is the NASDAQ. We have been outperforming the NASDAQ since the 2007, 2008 market top, the SP 500, and the typical 60-40 buy and hold, which is the underdog. Doing nothing with your money is definitely a slow way to grow it. And last month we hit new all-time highs with our CGS strategy. The recent pullback has pulled us a little bit back off those highs, but overall we just continue to hold our value and aren't phased by these market corrections and sell-offs. We don't have to worry about huge corrections. We can benefit from them. And right now our account is just slowly inching its way higher until we have a clean new signal in the markets. Anyways, that's it for now. Take care. Bye-bye.